Hi everybody, so looking forward to this week. Probably the three big things that we're going to be paying attention to is the ECB rate decision, US earnings, and that final announcement on who will be the next UK Prime Minister. So all of those things expected to drive specific asset classes, but overall, what we've been looking at more recently is a bit of a pullback in global equities, particularly in the UK and Europe. Also in the US, but still pretty close to record highs in the major US indices. We've seen gold stall out around that 1400 mark, but we have seen the British pound hit a 2-year low. Before that, as we mentioned, expected announcement probably of Boris Johnson, the frontrunner to be the next UK Prime Minister. Now, before we get into all that, we'll just have a look at the economic calendar for the coming week. So PMIs for Germany and the Eurozone on Wednesday. Presumably the ECB have already made up their mind about how they will go about policy change in Thursday's interest rate decision, but nonetheless the data will be of interest to see how well the European economy is ticking along. General take at the moment, I think, is that it's sort of based out at fairly lackluster levels. Inflation data from Japan, normally a big bit of data to watch out for, but the yen really being moved by global bond yields at the moment, and Japanese data really very much down the pecking order of what's actually driving these yen pairs. Interesting one is the preliminary release of US GDP for Q2. That's expected to fall below 2% year over year, so obviously not the high-flying growth that Donald Trump would like. So as we head into this US earnings season, we're expecting a drop in the S&P 500 earnings for S&P 500 companies of around minus 3% in Q2. Now, if that actually were to happen, that would mark the first quote-unquote earnings recession, so 2 consecutive quarters of earnings declines for the S&P 500 companies since 2016. So that said, most likely what's going to happen here is that companies have forecasted a certain set of earnings, but actual earnings will come in well ahead of them. In fact, historically, it's around 4.8% higher, the actual results, than the estimates. So by that nature, for minus 3, we tick over into maybe 1.8% positive earnings growth in the US. We expect to see plus 3.7% revenues growth for S&P 500 companies. That would be, again, if it comes in, would be the lowest rate of growth in revenues since 2016 as well. So you can see there's a kind of underwhelming underlying theme here. The earnings are not too hot. A big bellwether for what could drive markets and the overall sentiment towards this earnings season, which again is not super high-flying numbers, is the results of some of the big tech companies. So next week, we do have results from the likes of Amazon, Alphabet, and Facebook. So if, like Netflix, they don't come in as investors expected, these companies, of course, are all priced to perfection, and we could see the share prices decline and drag overall markets down with them. Now, as we head into this ECB rate decision, the euro against the dollar is hovering around that 112 level. We think most likely with this overall bearish trend, probably the euro dips below that 112. Why might that be the case around this meeting? Well, the ECB is leaning pretty dovish. The latest bit of information that we have is that actually Christine Lagarde, the IMF director, a pretty well-known dove, at least while she was at the IMF, she's certainly been calling for more rate cuts than she has rate hikes. That sets the precedent, sets the tone for general dovishness at the ECB. Maybe there was a possibility if a hawk was coming in like Jens Weidmann from Germany, perhaps the committee might have been a bit more hesitant about moving towards policy stimulus again before the new president comes in. But with Christine Lagarde, that's probably not so much the case. We also know that the ECB have been considering changing their inflation mandates. At the moment, it's, what's the exact words? It's below but close to 2%. They want a bit more symmetry around that. So presumably, if inflation's allowed to go above 2%, then you can press a bit harder on the accelerator in terms of stimulus so that you can actually go for a few more rate cuts and allow inflation to be higher while you're doing so. So those two factors, a bit dovish for overall ECB policy. We don't expect them to actually do anything in this meeting. But that said, we think probably the most likely scenario is that in this July meeting, the ECB set up the possibility, the strong possibility of cutting the deposit rate to 0.5%. That's a 10 basis points cut in September. So that's going to put more pressure on European banks, which are already struggling, and it probably won't make much of a dent for inflation. So all that put together means it's probably just a signal that the ECB is willing to do more, that they haven't just hit a floor in their policy just because rates are zero and negative. They are willing to do more, and probably that next step would be QE, another round of quantitative easing, and that could even happen this year after Christine Lagarde steps in. Now, the timeline is that we've had a month of this Tory leadership contest. For the past few weeks, we've had Tory members being able to cast their vote between Jeremy Hunt and Boris Johnson, the two last contenders in this race. From the start, very much the front runner has been Boris Johnson, and we expect Boris will probably come out ahead and win this leadership contest for the Conservative Party, and thus he will become the new UK Prime Minister. We will know that on Tuesday the 23rd. So if there is going to be any volatility in the British pound, which has been looking fairly soft, as we mentioned, it hit 2-year lows against the dollar, it would be around that date. Now, we've seen a bit of a pickup in the last few days. That's because seemingly this tough talk from the UK Conservative frontrunners has seemed to have affected perhaps the way the EU are approaching things, and the EU's chief negotiator, Michel Barnier, has said that he's willing to try and work out some alternative to the Irish backstop. If you remember from multiple videos, that this Irish backstop was a key difficult point that stopped Theresa May's deal from actually being passed through Parliament. So if they actually can work through something, that would be more likely to get a deal, and obviously very positive for the pound. All that said, though, this slight little pop we think is probably just setting up another decline in the pound to deeper into 2-year low territory, just because if you have to look at what Boris Johnson is going to talk about once he is Prime Minister, the question is, does he either soften or harden his stance towards a no-deal Brexit? Well, it looks more likely that he would harden his stance because he no longer has the other more Remain-orientated UK Conservative Party members to have to balance against. And so then he really has to keep the pressure on the EU and make it very clear that the UK is willing to leave without a deal in order to try and get a new deal or some slight changes at least passed so that we can leave with a deal. So that's what he says. The counter argument to that is that, well, actually UK Conservative members are actually a bit more orientated towards leaving. So once he's Prime Minister, perhaps he can soften his stance a bit. I think probably the experience from Theresa May would suggest that wouldn't be something to do at this stage. It would be something to do later on, closer to that October 31st deadline. So all that put together, probably a bit more chance of a no-deal Brexit once Boris is in. We don't expect any big gaps in the market, but you never know. But probably the pound is still on a negative trend. Right, thank you very much for watching, and if you do like these videos and want to get them as soon as they're released, please subscribe to LCG on YouTube and social media.